Markets take a big hit today. My name's Des Woodruff here at Grok Trade. It's Monday, April 18th, 2011, tax day. And in the news, we have Standards and Poor saying that they downgraded or cut the outlook to the U.S. sovereign debt. The S&P affirmed its AAA rating for the U.S. sovereign debt, but adjusted its long-term outlook from stable to negative, meaning there's at least 33% chance that company will downgrade the country's long-term credit rating. Ouch. That sent the markets into a tizzy. Furthermore, we're dealing with Europe's debt crisis, and we see China doing some tightening of the belt to help offset inflation. So there's a lot going on out there. We got $4 gas. We have gold taking off pretty strong here. Check this out. So people are flocking to commodities. The question is that the smart thing to do? Well, the Dow rallied back today, only down 140 points. At one point, we're down over 200 points. We're down more than 2% for the day. Huge drop. The S&P down 1.1%, 1% here on the Nasdaq. Russell's down 1.6%. Big hit. Banks down quite a bit. There early in the session, we saw the banks leading the markets, and that made the stocks bounce pretty nicely. Wouldn't be shocked to find out if that wasn't POMO or the QE2 setting in and the Fed's pumping up those government bonds to get the market to rally. VIX at one point was at 19. Matter of fact, on Friday, I bought the 19 strike on the July calls, and they were up more than 16% at one point today. Not too shabby for a nice hedge going into today's action. Gold up 0.6%, but here's what's really hurting, gang. It's the US dollar seeing a major jump here, almost a full percent. Now, crude oil did drop almost 2% today, but let's take a look at this UUP before we get into the S&P. We have this drop, falling wedge, pop. There's our pop. We have two orange lines coming down. Highest close to highest close, highest close, and we're up past the blue line, but now we're going from shadow to shadow right here. That gives us a shadow line. And if we come to this shadow down to this shadow, that's where we close, where we're resistant. So we have those two lines acting as pretty good resistance and the 20-day moving average acting as resistance. But what has me concerned is the dollar looks like it's trying to find a bottom right now, and it's doing it on huge volume with a bullish divergence on the MACD. Wow. So the question is, what do we do with our money? The markets in the last 2 years are up about 80%. You have people hungry to start taking profits right now. And gang, this is what we're looking at. Today, the markets were spooked by the S&P coming out with its concerns, and we dropped with a little bit of a rally taking place. But if anything really bad happens, this market could really go into a slide. We're sustaining some significant damage. Look at this double top. It's a lower swing high. Do you see that? Gang, a lower swing high is no good on a market that's supposed to be going bullish. Now, we've been going bullish a long time, but here we're in a triangle. I want you to look at this triangle. Going back, I know I'm taking a little bit of time here, but I want you to be an educated, savvy trader. We come up here, and that's where we're at. We actually found a little bit of support right here on that trend line today. Now the upper trend line, higher swing high, and then we go to a lower swing high, highest close to highest close. That there gives us a symmetrical triangle. That symmetrical triangle is building power. Do you see these moving averages, how they're starting to condense into the middle of the triangle? I know I have a lot of lines here, but I want you to see this. Look at the moving averages. They're below, acting as support as the markets are up here. But look how they're starting to intertwine with each other. Do you see this? Let me blow this up. I really want you to see this. See how these moving averages are coming together? That, my friend, is the markets pinching. The stocks hate to be pinched. Expect that we will get a breakout or a breakdown, and that will be a massive move one direction or the other going into the apex of this triangle. So that is what I'm seeing. I am also seeing more interest on the downside, especially with the VIX. The VIX at one point was up 23% today. Was a huge pop. That is people flooding in, buying call options on the VIX. And the volatility index is a good measurement of fear that's out there. So that's something that we are watching. If I bring in a weekly chart, look at this. Weekly chart, we have the makings of right here, do you see this? A lower swing high. But look so far on the week. The week we are below a massive trend line. Gang, that is very scary to see. Now, I'm really paying attention to this market 1302. We're not under that yet. If we break down below 1300, when we were there today, the weekly could get dangerously slippy and fall out of bed. Gang, the markets look like it's teetering on the edge of a cliff. This is your warning. Pass this video around. This is not to be played with. If I go here and show you the monthly, look at this. The monthly has gone up several bars in a row. We're having a hard time reaching that resistance. If you don't reach the resistance and we draw another trend line here that gives us a rising wedge, which in fact is bearish. That is a bearish situation. We have also a stochastic bearish divergence already taking place on the stochastic banded oscillator. Furthermore, we are in what's called overbought territory. We are overbought on all major oscillators, banded or centered oscillators across the board, but we are begging, it looks like we're wanting to head down and relax a little bit the next few months. Gang, this is a warning. I'm letting everybody know now that the markets do not look good. Now, I think after today's big drop and a hammer getting put in place, we could see another leg up here. Now, with that said, I still have my VIX calls activated, but I also picked up longs today on this run back up, thinking that we could get a little bounce here. So I have longs and shorts going at the same time. So I'm kind of hedged going into this, but I'm very cautious, especially if we start breaking down, especially if we get below 1300. That, my friends, will give us an opportunity to go bearish in the markets, and it could be a rough few months. Remember, the QE2 is due to quit June, and the markets like to have a foreshadowing into the future of what to expect. The S&P has already brought it the markets to to negative territory. Their outlook is negative, so that should not be looked at lightly. So, what should you do with your money? Should you keep throwing it into commodities right now, such as gold and silver? I think that you might be late to the party on that myself. Should you go into bear ETFs? I think that's a valid decision. Now, there's some talks out there saying that the bear ETFs could be building a bubble of their own. However, if the markets start to fall out of bed, those are viable things that you could look at. Remember, there's attrition, or anyway, you don't want to hold those bear funds too long, because you're going to see you're not going to see the same bang for your buck the longer those things are held. All right. So if you are having a hard time sleep at night, you're not sure what's happening out there, and you're kind of up in the air a little bit, it is great to go to cash. There's nothing wrong with cash. Matter of fact, if a play you could do is the UUP and look into this. If you think we are putting in a bottom and the markets could get hairy here, we could see the US dollar start to make up some ground here. So let's watch the volume, watch the dollar, and see what's happening. And please pass this video around to a friend and watch our pre-market video in the morning before the market opens, and then the ones in the afternoon. We will keep you abreast to the very latest of what's happening out there in the markets. We will tell you things that you're not going to hear the talking heads on TV talking about. Take care and very safe trading to each and every one of you.